Vice Chairman of Hyderabad Branch, CA Deepak Ladda, and Sikasa Chairman, CA A. Sitaram Reddy, and past Chairman, CA Y. Banarendra Garu, and all the senior members on the panel, and all the delegates. Welcome everyone once again. Before commencing the session, I request Vice Chairman, CA Deepak Ladda, to give overview of the today's program.
Thank you, Satish sir. I welcome our speaker of the day, CA Ganesh Balakrishnan sir, and all the members who have joined till now on a very important topic, that is regulatory changes in Schedule 3 and CARO 2020. Friends, as we all know, it is one of the most relevant topic for the present time for all our practicing chartered accountant fraternity as well as members in industry. The topic becomes more so important, especially from the point of view of small and medium tax practitioners. At times, at the time of reporting, we miss to update ourselves during our proceedings, the relevant changes which happen. To take care of this, we have our speaker, CA Ganesh Balakrishnan sir today, who will take us to the total changes what has happened in the regulatory framework for the CARO topic. Thank you, Ganesh sir. We are really blessed that you have accepted to address the members on such an important topic. Thankful to you. Friends, as we all know, Ganesh sir is a very important resource for Hyderabad, especially when it comes to the Companies Act matters, IFRS and other relevant topics. With such an important topic and great resourceful speaker on the dais, I don't want to waste any time, and surely member will be eagerly ready to listen to him. I give the proceedings back to our secretary. Thank you for the opportunity.
Thank you, Guruji. I request Banarendra sir to give very briefly his remarks. Welcome, Daya sir.
Learned speaker of the day, CA B. Ganesh ji and Dayaniva Sharma ji and all the dignitaries of the Hyderabad Managing Committee. Today's seminar has a lot of importance, so better I suggest we all listen to Ganesh Balakrishnan ji. I have spoken many times, so now it is Ganesh ji's turn, but only one request to all the attendees. Please post your questions only in the Q&A box. Please don't post your questions in the chat box, because we'll be missing the questions, because I know we may come up with a lot of questions. We may have a lot of questions which require to be answered. So if it is put in the chat box, we may definitely, there is a high probability that we will be missing those. Over to you, and thank you for giving me this opportunity.
Thank you, Banu sir. Welcome to our Central Council member, CA Dayaniva Sharma once again. I request Daya sir to give opening remarks of the today's program, please.
Thank you, Secretary. It's been a pleasure that when a person like Ganesh Bhai actually comes and shares his view, it makes a whole lot of difference. And a man who's I'm sorry, my throat and everything is bad. I'm running with a temperature. But yes, because Satish Bhai is here, so Ganesh Bhai was here. I thought just to come and say hello to him, and also tell all the people the regulatory changes which are coming in the Schedule 3 and CARO 2020 are becoming very critical with regards to whether it is NAFRA, whether it is with regards to FRRB or multiple regulators which is actually looking into certain aspects. If you actually go back and see the comments which are being given and the book which has been released by FRRB, where the gaps have been reported, it will give you all kind of inputs, whether in compliance of accounting standard with compliance of reporting in CARO or Schedule 3. Ganesh Bhai, you know it very well. A lot of firms are actually getting gap in between the Schedule 2 and Schedule 3, and some of the other factors are actually keeping them confused to report certain things. So I request each one to please listen to Ganesh Bhai, because he's been on the various boards of the institute. He has actually been reviewing multiple financial statements, and more importantly, one of the most important person in Hyderabad post PRSR retirement. He actually has been doing multiple reviews, and whenever we have any doubts or clarification, he is one man to go for. So it's always a pleasure to listen to him, understand from him, and learn from him. So I'll not come in between for much time. Yeah, and when a learned speaker like him is there. So over to you, Satish. Thank you all. Thank you very much.
Thank you, Daya sir. Before hearing the session from Ganesh sir, I request our CICASA chairman, CA Sitaram Reddy, to kindly introduce the today's speaker, CA Ganesh ji.
No. I think
Briefly, sir, briefly only.
that be done with it. Yeah, introduction is, I just not spend time on introduction. Thank you so much.
Briefly, sir, briefly. Yes, very fastly, please. Yeah.
Thank you, Secretary sir. Introduction is not required for Ganesh Balakrishnan sir. He is well known and renowned speaker in the Hyderabad circle and other circles. This is small 2 lines of brief introduction. Ganesh is a partner in the audit and assurance practice with 3 decades of experience, and he is the office managing partner of Deloitte Hoskins and Sells LLP from Hyderabad office. Ganesh heads the learning and development for South Asia's cluster of Deloitte audit function. Ganesh is a part of the IFRS faculty with the Institute of Chartered Accountants of India for all their in-house and open house programs, and serves as a faculty on Dun and Bradstreet for their programs on IFRS and US GAAP. He is a co-opted member of the research committee of the Institute of Chartered Accountants of India for the year 2015 and 16. He graduated from Usmania University and is a fellow member of the Institute of Chartered Accountants of India and cost accountant. He is also a certified public accountant, CPA4. This is a brief profile about Ganesh sir. Over to Ganesh.
Thank you, Sitaram Reddy garu. Ganesh sir. Now,
Thank you very much, and
report is yours.
very good evening to everyone. And there, I was actually telling everybody that this is the first program that I'm doing this year. And last time when Pankaj was there, I was doing so many programs. So I said, is it what Hyderabad is disliking me to do a program? But they said no. But nevertheless, thank you so much for being there. And I understand today the code of conduct is kicking off. I think so. We will be missing all the stalwarts on the screen going forward, right? But nevertheless, all my best wishes for all the people who are contesting. A very good evening to all the professional colleagues in the fraternity. Thank you very much. I did have one session last week with Mr. Amarjit Chopra. We had a debate for 3 hours continuously, and I think that is something which was very inspiring. In fact, I told Mr. Amarjit Chopra, I think something that you can learn from a person is the knowledge, abundance of knowledge that you can take. So next time, whenever Mr. Amarjit Chopra is around, please do attend, because he does give information which are very relevant and which are important for all the professionals. One of the asks when the chairman of Hyderabad talked to me was on the regulatory changes. And I think this is a very important change. Again, let me put this way. It is not an accounting standard change. It is not a change which says, it is applicable to small companies, medium companies, large companies. The question here is, this change is imminent. It's already effected. It's effected from 1st of April 2021. That means we are 5 months down the line that where we need to look at this aspect of it and implement. And I think that is something which for all of us as practitioners, for all of us as users of these financial statements or preparers of the financial statements, we should take cognizance. There are significant changes. In fact, one of the questions which came up is that, the first thing that was changed was CARO 2020. And there was no changes made in the Schedule 3, which is primarily the financial statements, which is prepared by the management. The question then came up is, who is responsible for preparation of a financial statement? Are the auditors responsible or are the management responsible? If you put all the onus on the auditors to report, and if the management does not prepare, then how does an auditor do? What does an auditor do? And I think this is a question which went back to the MCA, and MCA through their committee worked through it, brought in significant changes in Schedule 3. And Schedule 3 is nothing but the financial statements, that one which is prepared and presented and which is audited. There are changes that are coming through in terms of small companies, but keep as it may be, but this will not impact as much as the presentation or preparation of financial statements are concerned. So in today's topic that I'm going to touch upon, I'm going to talk to you about the specific aspects of it, which are very relevant and which, every person should be aware of it. So I will talk about the amendments to Schedule 3. the company's auditors report order, and some of the Q&A which we have prepared internally to just to see, the FAQs that we have prepared just to see how does any of these interpretations relating to our reporting responsibility relate to. And I think there are significant changes, which is very, very important. So let's look at, when was this introduced? This was introduced by the MC on March 24th, and it does talk about applicability. It talked about applicability relating classifying between Division 1, which is basically companies which follows accounting standard, Division 2, which follows the Ind AS standards, and Division 3, which was NBFCs. Now, what is the purpose of this financial statement? And I think one of the asks which came back, if you see today's financial statement, the way it is prepared, the way it is presented, no individual or no stakeholder or the users of the financial statement will be able to understand. I think that is what was required. And if you see predominantly, when you see some of the companies which are listed outside of India, if you see their management disclosure and analysis report, that's humongous, that's huge. Whereas in India, it's just follow the Schedule 3, earlier the Schedule 6, and then give up the financial statement. Now, this is where the transparency and the transparency comes in when you have an enhanced disclosures. And this amendment, which was come into this balance sheet or the Schedule 3, was to align with the auditor's reporting. And I think this is a very important aspect. This brings in the aspect also of the new code of ethics, which was effective 1st of July 2020, which really talks about our role as auditors, our role as professionals in public practice, our role as professionals in service. And I think this is a very important aspect. For all this while, it was only the professional in practice were impacted. But with this effective code, with new code of ethics that came in, it is also the professional accountant, and the new definition of a chartered accountant is called professional accountant. In service is also included. And I think that brings in a lot of responsibility, both on the preparers as well as on the person who are auditing this financial statements and issuing a report. So both on the company who are the preparers and the auditors who issue an audit report. This impacts balance sheet items. This impacts profit and loss account, the statement of profit and loss. This impacts statement of changes in equity and the notes to accounts. I try to make it what are very critical in terms of a legend, which requires in red, it means which is critical for all of us. And there are green, which are basically, it means that, it's more a disclosure, may not be so much of rigorous in that aspect of it. Now, let's look at the division. In fact, one of my professional colleagues asked me, is there a distinction between those companies which prepare financial statements under the old Indian accounting standard rules 2006 versus the Ind AS versus the NBFCs? Now, I think let be very relevant here, because they did talk about on the FRRB, and I think FRRB has been there. They have been issuing reports. They have been sending information about the findings to many of the CA firms. Are we serious about those findings? That's the first question that comes through it. The second question is, and if you see for the past 6 months, 6 to 9 months, the ICI has been predominantly spending time on auditing and accounting standards. Never in the history has been where so much of focus has been given by the institute on auditing and accounting standards. And why these are very, very important. Our auditing standards are very important because that is the basis on which we issue an audit opinion. That's basically predominantly demonstrates the work performed by us, and using the work performed by us, what we have documented, that's formed the basis of an audit opinion. And I think that is a very, very relevant aspect, which we all believe that auditing standards are just a checklist we can fill in and do it. Slowly, if you see NEFRA, which is coming through it, you look at larger companies which got impacted. You have now medium Indian firms which are getting impacted. Now, this is a journey which will continue. There is another agency regulator, which is the QRB. Now, the QRB has now going to have the technical reviews conducted on private limited companies, on unlisted companies not covered under NEFRA. And these companies and all who are the people who will be inspected, which are the audit firms? Less than 10, less than 20, greater than 20. That means every firm which has and does an audit of a private limited company will be covered over a period in time. And therefore, whether you have a classification under accounting standard rules 2006 or a classification under the Indian accounting standard or an NBFCs, all of these will be applicable. And I think this is a very critical aspect of it. Now, if you see the financial statement, which predominantly is a Schedule 3, which is the guidance for all of us, and for especially under Section 134, where for the company, the CFO is responsible for the preparation of financial statements. Now, larger issues have come through it. In fact, if many of the NCLT cases, many of the banks have gone back, and in fact, the basis on which this Schedule 3 has undergone change is the feedbacks that have been given by the bankers, feedbacks given by the ROCs, feedbacks given by various regulatory agencies when they had done an inspection and where they found that there has been lacking in terms of certain information which has been captured. If you were to look at ourselves, in fact, this was one of the moot point which came up during our debate with Mr. Amarjit Chopra, was on fixed assets, which is now defined, renamed as property, plant and equipment. If you see our CARO reporting, we always say that the fixed assets, the company is in the process of updating the fixed asset register. The physical verification has been planned in a programmed or a phased manner. Any discrepancy relating to that will be accounted or adjusted as and when the company does. Just look at this. This reporting on fixed assets by us for n number of years have been at the same level without even changing the name. Now, the question then came up, when you classify certain assets or a liability, whether it is a secured or an unsecured, what is the basis? The basis of classifying any asset or a liability under a secured is the basis of security that should have been charged, should have been created. And this brought in a lot of issues relating to security charge or the charge on the securities not being created. And this has brought in, and this is a feedback which went back saying that many companies did not file the register of charges. Many companies did not, even though as given fixed assets, property, plant and equipments, but they were never verified. Now the bigger question came up. There were transactions which happened. Hands changed, the land deed changed. And if even today, if you see, there have been many GPS that have been issued to various companies within the company through an AGM, and through that means that through a GPS, the asset lands have been sold or the properties have been sold. I think that is a very important aspect, and that is the reason why the title deeds of immovable properties not held in the name of the company is required, irrespective whether it is Division 1, Division 2, Division 3. That means whether it is accounting standards, Ind AS or NBFCs, all will be covered. The other aspect which was played by majority of the companies was in terms of revaluation. Revaluation exercise was always brought in by the company because using a revaluation surplus mode, you used to increase the value of the asset. Therefore, when you offer a security, that security has at an increased value. But now, if you have any revaluation that is carried out on a property, plant and equipment, it should be based on the basis of a registered valuer as defined under Section 2 of the Companies Act. And I think that is a very critical aspect of it. That is, you cannot keep on revaluing your assets. Any changes more than 10% in the value, you should report, and the registered valuer should be appointed by the board and they should provide a report. The second aspect. The other aspect of the black money which came in was the Benami Properties. Someone asked this question, the fraud, and in fact, this is a very important aspect of it. How does a fraud happen, and where does a fraud happen? The fraud happens through related party transactions. The fraud happens through Benami transactions. Who is the owner of these Benami transactions? You can give an advice under related, but suppose somebody comes to you, sir, ye hamara related party transaction mein nahi aana chahiye. What do I do it? You say, you go to the schedule which is given under the Companies Act, says 1, 2, 3, 4, 5, 6, 7. These people are not to be included. So you give not related. So you have a brother's wife, to bring the brother's wife. But the unfortunate part of it, that the transactions are held in others' name, even though the transaction is done by the company or by the promoters. Now, this is something which has evolved either because of a demonetization or because of the technology changes that are going through, because of the artificial intelligence which has been done. In fact, if you really were to see the very recent, the income tax, when you filed a return in the year 2020, sometime closer to the month of March, everyone who was up to a particular limit received notices saying that your return of income versus what you have reported there is a mismatch. And I think that is where, when you have an artificial intelligence used by the income tax department, I think that is something which is coming. Today, you see there are technology challenges that are happening with the new portal. But again, if anyone were to understand the gravity of that portal, the portal is connected to SEBI, connected to banks, connected to income tax, connected to GST. Everything is connected. So it is managing a whole data. It's managing a big data. And I think that's where the whole challenge is coming in terms of having a lot of this. But the day those technology, disruption goes away and it becomes smooth functioning, whatever you file return, in fact, this is called pre-populated. Your interest income is pre-populated. Your deposits are pre-populated. Your transaction through TCS is pre-populated. Every capital gains is pre-populated. So what is there in the return? If every transaction gets recorded, I think Benami Properties, it'll be another issue which will come through it, if at all there has been a structuring that happens to it. The other aspect which has been introduced for all is in respect of the working capital. If you were to see the working capital, there is this working capital returns, the inventory stock statements are issued. All of these are debtors information, payables information, everything is provided to the bank on a regular monthly basis. Now, when you have a quarterly statement or a statements that are filed with the banks or financial institution basis on which a working capital up to 75% or depending upon 70, 60, whatever the percentage based on security, they issue the working capital limits. These stock statements never agreed to the financial statements or the books and records. Now the onus is on the statutory auditor to do it on a quarterly basis. Now the question is the responsibility to say that you audited? The answer is no. But whatever information that is provided and submitted to the bank, whether that information has been extracted from the books and accounts, and I think that becomes an onus on the auditors. Now just look at it. For a listed company, they do a closure of books every quarterly, or some listed companies close it on a monthly basis. Majority of the private limited companies or limited companies which does not have the quarterly closures or the monthly closures normally do it at the year end. That is where the challenges would come through, and this is a very important aspect. Now, one of the aspects which I always believed, which is very important, is on related party transactions, transactions with promoters, transactions with directors, transactions with key managerial persons. I think, the system was abused in such a way that you borrow a loan on the parent company, give it as a loan, as a salary advance, give it as something to the promoter, to the executive directors, give it to the key managerial person, give it to somebody in the subsidiary joint venture. That means you take a parent company and you take a decision and you keep diverting it. This information has to be given by the company. Loans or advances, nature of loans granted to promoters, directors, KMP, whether payable on demand or whether without specifying terms, or if there are any rollovers. The other important aspect that has been brought in is the utilization of borrowings for the purposes other than which was taken. Now, this is where you need to play a major role. Amounts that have been spent for other than what has been issued. Take a term loan, take a working capital loan. If you use a working capital loan for capital expenditure, or a term loan for working capital, or for any loan that you have taken and utilized it for any other purposes, the onus is on the company, the onus is also on the auditor. Now, how do you do it? Unless you go through the entire bank statements, unless you go through the entire cash and bank transactions, you will not be able to identify. There is no, somebody might say, I will look at the cash flows, which is prepared, and cash flows never tally. At the always, if you see, the focus is always on balance sheet, the focus is on profit and loss account, but the cash focus is not on cash flow statement. But when you look at a utilization, you need to go to the every transactions which are recorded in the bank statement. Majority, you need to look at the major amounts that have been looked at it. So far I could have done a bank reconciliation for 1 month. I could use a materiality or a sampling methodology and done it. Now, when you do a reporting under the borrowings, when you do a reporting under what is called as CARO, you need to look at all of these. The other important aspect is whether a company has been declared as a willful defaulter. Where do you find this information? The company will not disclose to you. The banker does not give you. You need to send out information to the bankers. In fact, this is one of the suggestions which we gave it to the back to the some of the members in the council, saying that should now the SA 505 on declaration on confirmation of balances not include this specific component when you seek confirmation from a bank, to include whether this entity was declared as a willful defaulter. A willful defaulter is categorized based on the failure to pay the what is called the principal and the interest for a particular period in time. And I think that becomes a very important aspect. Even in a consortium, you may have 5 or 6 banks, but even in one bank, in the rest of the other banks, there has been no defaults, but there's this some other bank, there is a default. Even then you need to bring this aspect of it. Don't go on the basis that majority of the balances have been confirmed or we have not got confirmation of balances. What does it mean to the company and what does it mean to the auditors? The auditors needs to plan early. The auditors needs to be engaged with the company, needs to be engaged with the outsiders. And I think that is a very critical aspect. Ratios, the solvency ratios that have been brought in for division 1 and division 2, division 3 is on NBFCs relating to the capital to risk weighted average. All solvency ratio, whether it's a current ratio, whether it's a debt equity ratio, whether it's a service ratio or a return on equity, all of these ratios at this point in time, the calculation is assumed to be what we have been practicing in the past, what we do as a part of the disclosure in the ROC. But there are certain guidances which are still expected, but it won't be any different, the one that you actually compute, whether it's an income tax purposes or whether you compute it for the purpose of filing with the abstract for earlier, it's the abstract 4 of the before you had the XBRL. This is a very important aspect. Any changes more than 25%, you need to explain between the previous year. That brings the question, whilst this balance sheet or the schedule 3 is effective 1st of April 2021, there are arguments and counter arguments saying that whether I should prepare a previous year or whether I should prepare for only for the current period. But if you have to compute a ratio, you need to have something which are comparable. So therefore, you need to look at something of the previous year also. So I think this is something, whilst this has not been explained, but I think if it go by deducing what is expected, you may have to have also the previous year's numbers. So you might want to give a note saying that wherever it is not possible as a part of the information. Now, what are the other changes that have been impacted? And the beauty part about this is on the prior period errors. Now, the prior period errors was not there before. If there are any errors, we used to, under the old accounting standard, you say prior period error and be done. And that's the reason it is not applicable for division 1, which follows the accounting standard rules 2006. But it is applicable if there are any prior period errors. And this prior period errors are those which are material for the users. It could have an impact on the profit and loss account. It could have an impact on the line item of relating to your balance sheet or financial assets or liabilities. If there is an error, you have to use this, what is called as a restated balance sheet, restated profit and loss account, which was never heard of before. All the while, we've been using what is called as prior period errors or errors, previous year's figures, wherever we have pre-proved. But this prior period errors, by bringing the restated balances, will have an impact both on the opinion as well as on the information that is prepared by the company. Shareholding of promoters. It had a percentage more than 5%. Now entire shareholding information has to be given. So not only the shareholding, if you go by the definition under SEBI, also the connected persons. Connected persons are those people who are not directly related, but the behavior, the manner in which they transact with the company, they make them to be a part of the promoters group. And I think this is a very important aspect of it, which one's supposed to look at it. For listed companies, you will know it. For unlisted companies also, when you talk about friends and this one, you need to be very, very clear on it. The other aspect is on trade payables aging. Now, trade payables, we had aging for only sundry debtors. We did not have aging for any of this. Now, this trade payables aging, the trade receivables aging, aging for capital work in progress, intangibles, aging for any of those matters will require much more broader analysis. It is nothing that greater than 6 months, less than 6 months. It will be categorized between disputed and undisputed. It will be categorized between legal and not legal. Just imagine, you're actually splitting the entire balance sheet in providing more information. Suppose you might say greater than 6 months. In the opinion of the management, it is all recoverable, good and recoverable. Now, in that greater than 6 months, 60% or 70% are legal and disputed cases. Just imagine this information, which is not available before, you're making it available to the users. They will be able to understand and appreciate, saying, hey, listen, is this the company that I'm investing? Is this the company where I'm funding? Is it the company with which I'm working? Is it the company which I'm dealing as a customer or a supplier? Look at this aspect of it, which you're giving as a ready-made. And I think this is where the disclosure becomes very, very important. So you can no longer go under saying that, I will give you only this information. In fact, one of the biggest issues came up was in terms of segment reporting, in terms of, classifying certain customers which had particular transaction more than 10%. I think these are something which were hidden in accounting standards. With this aging which is coming through, will have significant impact. Trade payables aging from the due date of payment, payable to MSME. Now the MSME classification has gone up from 5 to 25 to 50 to 250 crores. So much of changes have come through it. And I think that is where you need to be very, very clear in terms of classifying aging. Now, what do you need to do for MSME? MSME has got a report. Every company has got a reporting requirement of filing it with the register of companies on a half-yearly returns. Now, if you look at the half-yearly returns, how many times does the company update the MSME? With this increased enhanced limits, how many times does it do it? I think that is where you need to start looking at it. Go back and check on your MSME classification. And this becomes very important. For all the professionals who are in practice, for all the professionals who are the CFO in service, this is a very important aspect of it. Get it early. How early is now? Already 5 months is over. You can't wait at 31st of March and then come back and say, oh, auditor, you should have told us before, you are coming to us late. I think this is a responsibility on the company itself. So for the auditors, for the professional accountants in practice, you should go back to your client and share this is what is required. And for those professional accountants in service, this is something which you should be aware of it. Look at the classification of CWIP and intangible. And what is very important there? It is not the aging of it. It talks about when the completion is overdue or the cost has exceeded when you compare to the original plan. So therefore, you need to look at the budgets, original plan. You can't say there was a revision, there was a delay, there was a COVID, there was this thing. But all of these will have to have information. Does it have an impact on your capitalization of interest or other thing? The answer is yes. The moment you say this got delayed because of this got delayed, you have to suspend the interest capitalization or capitalize expenses that ordinarily gets capitalized. And I think this is a very important aspect. The other important thing that come up is on the fair valuation of investment property for disclosure. Again, any investment property has to be done by a registered valuer, and it's a very critical aspect. Next, there are more than 2 lakh companies which have been struck off over a period of last 3 or 4 years. The relationship between this company and the struck off company, somebody asked the question, so how do I find the struck off companies? All you have to do is, if there are any amounts that have not been received for more than 1 year or 2 years, go and check in the ROC website, check whether this company existed or not. If the company has not existed and you're showing this amount to be recoverable from them, that becomes a significant issue, both from a company's perspective as well as from an auditor's perspective. Delays in registration of charges or satisfaction of charges, and this is a very important aspect. This has been missed by many of the companies because they think, sir, ROC side काम नहीं कर रहा है, sir. The bankers are asking so many questions, sir. That's the reason not delay. And it is not 6 months, 1 year. It is 2 years, 3 years, 4 years. Sir, the other bank is not giving us no due clearance, and hence we are not creating this charge. This information requires to be captured. Compliance with number of layers of companies. You cannot have more than 2 investment layers in companies. You cannot have more than 2 layers. That means your investment company cannot be more than 2. So your holding company, your investment, and next is another investment. Below that, you cannot have another investment company. Again, this is was a rerouting of all of this monies. Compliance with the schemes of arrangements, which is nothing but your mergers, amalgamation, which happens through the court. Details of funds, guarantees, security given, taken from intermediaries for onward utilization of the ultimate beneficiaries. Look at it. Guarantees, securities, funds, typically the relationship which happens between parent company to subsidiaries, to joint ventures, to associates, amount of funds, guarantees that are given. Securities for entire thing could also include your security shares and stocks. And this is where you need to be very, very look at the utilization. As much as for the CSR today, the recent frequently asked question is, if you have cut a check and given to a foundation, it's no longer sufficient for the entity to claim saying that you've spent for CSR. You have to get the end use certificate saying that that foundation has actually spent that money from the funds that you've given. It cannot be to their own company employees. It cannot be for anybody else. It should be for public. I think that is a significant change which will have impact. Details of trading and investment cryptocurrency. Somebody asked me in that saying that, sir, हमारे India में तो banned है, कहाँ से आएगा? But let's say you have a company which has actually got subsidiaries and trading in this cryptocurrency. You will have to look at it. Do we have the knowledge? Do we have the expertise? The answer is no. We don't have the expertise. Do we have to look at the literature outside of India? The answer is yes. Is it something that we are time and tested? The answer is no. It's evolving. So therefore, if any cryptocurrencies transactions are happening, please don't watch YouTube videos or some of those experts who says, aisa karega, aisa. Not that way. You need to understand, this is specialist work, and you need to understand the balance, how it is done. Rounding of amounts has already been there. These are something which are very critical. Now, the other aspect which is required is small modification that has been brought in terms of classifying the current maturities of long-term as short-term borrowings from other current liabilities, because it was getting subsumed. Any borrowings which are short-term borrowings was getting subsumed under other current liabilities. It's only a reclassification that you need to do. Current maturities for other financial liabilities borrowings and security deposits to be classified to other non-current assets. These are small changes that have been brought in. So let's look at the summary of amendment from a high, a medium, and a low. For the preparers who are basically the professional accountants in service, for the users who are the professional accountants in practice. Now, the ones which are on red means it's important both for the company and for the auditor. Aging of trade receivables along with categorization of disputed and undisputed, good and doubtful, disputed, undisputed. Trade payables, disputed, undisputed. Capital work in process, intangible assets, aging. Title deeds not held in it. Disclosure whether fair valuations. Now look at the first 4 aspects of which are very, very critical. The other aspect which somebody might say, sir, the fair valuation it is not critical because you may not necessarily carry out every time. Now, changes greater than 10%, both balance sheet and CARO, if you see the next part of it, if you see which is critical, Details of quarterly returns and summary of reconciliations are critical. Details of utilization of borrowed funds and share premium, diversion of funds. The responsibility now under section 143.12. Now, this is where a lot of issues will come up if we do not report on diversions as 143.12. It is not fraud on the company by the employees of the office. If the fraud conducted by the company, which we believe because of a diversion of a fund, we may probably require this to be reported as fraud. And I think this is something which is a very critical aspect. I do not know where it will lead to, but let's say we fail to report, probably will run into an issue. And I think that is something which we need to look at it. Details of where funds are used for utilization of borrowed funds, not for specific purposes. Compliance with number of layers of companies as per Companies Act. So look at all of these disclosures. These are the disclosures which is required by us, both as by the preparers as well as by the presenters. Now let's look at the changes in much more detail for an understanding part of it. I'm actually bringing in some sort of this is only a pictorial presentation, how it looks like. It can be changed, it can be different, but also what you should look at from an this is an attempt which we try to do to make more easier way of understanding the Schedule 3. Now, the original requirement under the old Schedule 3 was trade receivables was supposed to be classified between secured, unsecured, considered good, and doubtful. That's a very simple thing, no issues. Now, the format requires you to classify between undisputed and disputed. That's number one. Within undisputed and disputed, you need to classify between considered good, considered where you have significant increase in credit risk, and credit impaired. If credit impaired is nothing but a provision for or bad and doubtful debts, right? Both for undisputed and disputed. Now look at it. The moment you say disputed, it gets into the classification. Let's say the disputed means get into legal. Now, where do you get this information? No longer you can just send, I have sent a confirmation, therefore I've got the confirmation, I've not got confirmations, and you go and get a representative from the management. Management say this is aging, we are confident we will receive. Every year it gives, it is confident it will receive. But if you have not received, it doesn't fall under the Ind AS. At least under Ind AS, you've got what is called expected credit loss method, which you use to impair the asset using a credit risk analysis and a time value of money analysis. Whereas in the normal accounting standard rules 2006, you don't have that classification. When you don't have that classifications, you need to bifurcate between which are undisputed and disputed, classifying between credit risk and credit impaired. That means you need to talk to the legal counsel. You may have to send confirmation of legal with the legal department, talk with the legal department, get an analysis and make a provision. This information, you cannot do it just sending out a confirmation, but you need to stay invested with the company. The company financial department should talk with the marketing department, should have much more information available to make sure that this information gets captured. Is there a compromise on this? Can I give my own this thing? Can I say one CFO comes back and say, hey, sir, listen to me, other companies doing, can I do it? The answer is non-negotiable. If you're an auditor and if there is classification is not as per Schedule 3, then you need to bring in your auditor's report saying that the classification relating to this is not in accordance with that. And I think that becomes a very critical aspect of it. How does it impact? Technology is impacted, processes are impacted. It is not only your own, if you're doing a consolidated financial statements, if you've got a group reporting, all of those entities also should provide you information so that this information flows into this. And this is a very critical aspect of it, which you need to look at it. Next, trade payables. Again, trade payables should be classified between MSME, others, disputed and non-disputed. Just look at it. Less than a year, 1 to 2 years, 2 to 3 years, more than 3 years, and all of that total. Now, you need to have from the due date of payment. Somebody might come and say, sir, there is no due date of payment. We have got these things. Now, you may also have unbilled dues. You have a lot of these unbilled revenues, unbilled receivables, and unbilled dues. All of these needs to be classified using that. And I think this becomes a classification. It's an automated system. You have an issue. It's not an automated system. It's a manual system. You need to extract. And these are some of the changes that needs to be brought in. Next, Disclosure relating to capital work in progress. Now, if you look at the capital work in progress, some of the aspects that, again, you need to look at those projects which are in progress, those projects which are suspended, classify between that. Now, even whether it is a CWIP or in the intangible assets under development, both has to be given less than a year, 1 to 2 years, 2 to 3 years, and more than 3 years. Now, wherever it is temporarily suspended or anything has been done, somebody might say, sir, there is huge market, sir, market viability is there, but they don't do anything to it. There is every scope of an impairment that could happen to this intangible, which has been under suspension or which has aged for a longer period in time. This is the onus is on the company. The onus is also on the auditor. Title deeds, the classification of title deeds should have the description of the item, the relevant line item, gross value of the property, title deed held in the name, title deed held in the promoter, director, relative name, property held since which date, reasons for being held not in the name of the company or reason being held in the name of the company. Just look at all of these. You have to go back to the, your classroom, or you have to go back to the boardroom and then start re-looking at all of these information. These information, you might say it is captured in my permanent audit file, but these permanent audit files are not completed. They are never updated. So you may have to go back and start re-looking at all of these documents once again, including those leased properties. Somebody might say, so the leased property has got executed lease agreements, but these lease agreements are not registered. Then you still will fall under this title deed. So these are some of the things which you need to start looking at it. Title deeds which are where you've entered but not registered. Sir, yes, a stamp duty le liya, sir, isme notarized ho gaya. It's as good as registered. The answer is no. Registration means you should create a register of charges, or if it is title property and should be on name, the title should have been registered with the respective regulators or the regulatory body or the agencies. In case sir, ये document miss हो गया, sir, पानी आ गया, floods आ गया, Hyderabad में बहुत सारा floods है, पूरा basement is all gone, all documents gone. Whether there is certified copies or details of FIR's file should be there, saying that which is the property, to who are the people, whether the insurance surveyor or any other agencies was involved. Where you're not able to get any of this information, then you need to go and get a legal determination, get an analysis from the legal counsel. Please, as a professional in practice, don't take the ownership on behalf of the company. You are not responsible for all of these. You are responsible only for reporting. When will this bite you? It will not bite you today, because today you might say, sir, आज हमारा बैंक लोन फंस गया, सर आपका रिपोर्ट दीजिए, and sir हम कल दे देंगे, सर कल परसों दे देंगे, सर तरसों दे देंगे. कल परसों और तरसों doesn't come to us. It never comes to us. And that point in time, somebody comes, a peer reviewer comes, or a reviewer from the QRB comes, a reviewer from an ROC comes and say, or a banker files a case on you saying that, sir, this is a document which has been certified with the title and its title does not exist. At that point in time, you can't say, sir, I trusted my client. There is no concept of trust. You should trust, but as an auditor, you should verify. I think with this, so much of changes that are happening in regulation, so much of changes that are happening in technology, time that we invest in technology, time that we embrace technology, time we understand the nuances of technology. No longer we can say, sir, please take a printout. I will take a printout and do it. There's nothing going to work. You should start getting to understand the transaction, start in that forensic mode. Again, I'm telling you, with all these regulators, they might say that you are watchdog. Somebody might say you should be a bloodhound. Somebody might say you should be a barking dog. Sir, bloodhound ho, barking dog ho, ya kuch bhi ho. Who is going to save you? It is you alone. You may have barked and said, sir, ye information nahi diya. But ठीक है, नहीं दिया तो आपने क्या किया? What did you do to make sure that these you're verified? What are the other source of documents? Sir, I filled up this checklist. I've asked the company. I've sent him a mail, 10 mails. I put it in my management letter. Sir, I've not got. What did you do with that information that was available with you? Did you make a mention in the report? Did you modify your auditor's report? If the answer is no, the company is in the process of acquiring title deeds, and based on the acquisition, once the company acquires this title deeds, the opinion will be done. Absolutely no. Either you have the title deed or you don't have the title deed. If you don't have the title deed, you should qualify. What do you qualify? You qualify CARO, you qualify internal financial control system. Because in your internal financial control reporting, you would have said that for every purchases of my fixed assets, I had a capital budget, I had a purchase requisition, I had a vendor selection, vendor evaluation, I had completed the asset was brought into this, there was a certification of the asset, it was put to use, and the asset was recorded, asset was paid, and this is what you've done. So when any of these things got failed, internal control fails. And this is a very important aspect. Please do not look at reporting under CARO or for a matter on Schedule 3 only from an angle of saying that, sir, हमने information दे दिया. क्या दिया आपने information? That the title deeds of the company is in the process of acquiring title deeds. How long? You have to provide that details. And I think that becomes very, very important. Suddenly it says whether it's held in the name of promoter, director, relative, all of this. This becomes a very critical aspect of it. Next, if you look at the reconciliation that is required. Now the reconciliation for a revaluation is in respect of any changes which are more than 10%. I think 10% changes, you need to look at all of these. And revaluation does not include fair valuation, property plant account when you're adopting Ind AS. Remeasurements is because of interest or foreign exchange rates or lease modifications. Implications is you need to look at each of these revaluations, whether it was conducted by a registered valuer, look at all of these and look at what is the change. And the disclosure related valuation by registered valuer, you need to look at whether you was appointed under the Companies Act, and you need to look at what was the engagement letter that was given, what was the report that was issued independently as compared to what the company provides. Next, original shareholding was only in the old Schedule 3 we only talked about before it got revised was more than 5%. Now the amendment requires you to provide all the shareholding of promoters, including the percentage of shares held with the promoter's name, number of shares, percentage of shares, each class of shares. All of these, the moments during the period has to be given. And this becomes a very important. Where do you get this important? Sir, हमारे पास तो company secretary नहीं है. Sir, हमारे पास तो secretary department someone else maintains it. Where will you find this information? You need to extract if they had filed with the ROC. You need to find next if there are a registrar who have they've appointed. All of this information should be captured as a part of the process. Next, where the company has made any loans and advances to promoters, directors, KMPs, related parties joining jointly, severally, and such loans are in the nature of loan payable on demand, give the nature of it. Type of borrower, amount of loans or advance in nature of loan outstanding, percentage to the loans outstanding. The entire spectrum of promoters, directors, KMPs, related party companies. Please do not go by the certification provided by the company secretary. Company secretary will have information which is provided to him. He may not have comprehensive information. But there is a reporting responsibility under the Indian accounting standards, under the accounting standards is 18 or Ind AS 24, which says related party transactions. That directly or indirectly. It does not give you an inclusive definition. It gives you an exclusive definition. It includes all of these matters. So therefore, you need to look at all of these aspects of it when you look at an Ind AS level, as well as when you look at the non-Ind AS level. So when there is excludes, then you go under the accounting standard rules 2006. When it includes, you go under the Ind AS 24, which is very, very important. I think that is something which we need to understand. Related party transactions should be understood by us, not from the nature of transaction or relationship that is disclosed by a director or a CFO or a managing director, but by the nature of transaction with the company enters. Why would a company give a particular person? You may have a situation wherein I may call for quotations and you will give only to this party. There was some case which happened in one of the companies which they said they appointed somebody as a CFO and they got someone whom they believe should be the CFO by calling people from those people who did not even have the competencies. And finally, they selected the CFO whom they wanted. How different is this when it deals with this loan with related party transactions? You will have transaction related party transaction which you will not be aware. You have given an advance. The advance is never repaid. Or you might have given an advance to a foreign company for them to build up an asset. 3 years, they don't even do it, because if you have to go through an ECB route, or if you have to go through any other route, you may have to get an RBI authorized dealer. If you have to give an advance for supplies, you can directly say, sir, I need to get my supplies, it is imported, so therefore it is available there, I send an advance. But that person does not supply for 1 year, 2 years, 3 years, 4 years, 5 years. Is it in the nature of a loan, advance in the nature of a loan? The answer is yes. You've not got the supplies, you've not got the money. But later on, you got through saying that, I will pay some money so that you get back the previous money. The rollovers, I think this is where we as an auditor, the professional person who was the CFO should be very, very cognizant. The responsibility is casted. Because now the responsibility is on the professional accountant in service. If you're registered with the institute, which ideally is like we have 3 lakh chartered accountants, 1,25,000 are registered, are professional persons in practice. The balance 175 lakhs are in service. If you take that, and if they are registered with the institute, because whether it's during elections or during non-elections, if they're registered there. Now, if anything that goes wrong at the company level, who is responsible? One is company responsible under the Companies Act. But the second person who's responsible under the ICI guidelines or the code of conduct, the new code of conduct and code of ethics, which says professional accountants in service. So that 1,75,000 chartered accountants who have registered with the CA Institute, who are not in practice, if they are working in any company and prepared a financial statement which had all of these informations, and that also includes the disclosure which is supposed to be provided as to be disclosed and not done, then they would be impacted. I think this is something which, again, I'm saying, please do not fill up this table, or do not tabulate these information just because you're supposed to tabulate all of this. The other changes which I talked about, the current maturities of long term, it's only a classification, because if you subsume everything into current liabilities, even though it's the current maturities of long term borrowings, it's actually a borrowing. So when people used to compute the current ratio, this other current liabilities you sometimes used to miss. And then anybody used to evaluate, sir, no, only we have long term borrowings. So therefore, when somebody were to invest in the companies, if he has no knowledge about the financial statement, how it is presented, this becomes an issue. Other financial assets, security deposits, bank deposits for more than 12 months from maturity, others all to be included. Lease liabilities should be on the face of the balance sheet, which is already there, but for all those entities which are not included before should have been there, should be included. So this was on the balance sheet side. Now look at the changes in the balance sheet side. There are significant changes which are there. I'll touch upon what is the responsibility from an auditor side when I come back to the CARO. But let's look at the Division 2 changes in the statement of profit and loss account. Undisclosed income. Now, this is something which is going to bite. I don't know how we as professionals going to respond to it. Two aspects you need to look at it. One aspect of it, when there is a survey that happens and the company goes and says, hey, listen, this is unexplained expenditure or unexplained income. You are one person who have issued a report saying that based on the information provided, based on the explanation provided, based on the examination of books and records, these financial statements give a true and fair view. Now this company goes and says, discloses, saying that, sir, humne galti kar diya, ye income hum log ne miss kar diya. Two things that comes through it. How do you deal with this? How do you deal with this? Is this something comes under section 143.12 as fraud because information that should have been recorded, or is it a restatement? Now, these are some of the questions which will come back to us and bite us. And I'm not sure how are we going to address if should there be any such transactions which was not recorded or surrendered as income. Unless there is an immunity. In fact, that's again a joke. if you go and say that I go and disclose under an immunity and I'm exempted, but does this exempt you as an auditor when you sign a financial statement? I think this is something which you need to look at it, whether you need to do a restatement of these financial statements. Again, I'm telling you, as much as there are a lot of the changes that are coming through, that small audits are going to go up. But as an auditor, you should also be cognizant that please don't take the responsibility of someone's problem under your belt, because you are not paid for it. You're paid for what the work you do. You are not paid for what the risk the company has taken and you are going to take on. Answer is no, because it will bite you not today, tomorrow. Why this is important? All of us are going through a very hard time using virtual audit. I do not know how many of us had the ability to go and examine records and really do it, verify it and do it. Now, these 2 years or 3 years, whatever is going through it, and we have issued report. God forbid, after 2 or 3 years, somebody comes and says, please provide me records, and say, sir, ye to bolo virtual mein diya hai. The guy said the company never existed. A great example is, it's a story which really happened, where automobile was sold by the company to a dealer for X number of crores, and was shown as turnover and was shown as receivables, and it was written off. Later on, when somebody went and did an inspection and found that the automobile dealer never existed in first place. Today you're taking information on a virtual basis. How are you satisfied the control surrounding this information that is provided? Somebody might say, sir, I trust my client, I trust my everybody. You trust. Anything goes wrong, what happens to the trust? You are answerable as a professional who is issued a report. And I think that is something which is very, very important. The other aspect which is actually assumed importance, which had a lot of debates, is on corporate social responsibility. Identifying a project, not identify an amount, not identified to a project, and the end use of funds. The responsibility lies both at the company level and also at the auditor's level to examine it, whether it is appropriate. Statement of changes in equity. Now, this is a very important aspect of it, which is applicable. And I think this is very relevant because changes in equity capital due to prior period errors. I think prior period errors will have a significant impact, will result into restatement. In fact, changes in valuation, changes in, some of the cases, what happened is in one company, the actual valuation used a previous year number to calculate the actual gains or losses. It got completely wrong. Because the company, when they sent that information, because the auditor was insisting, was troubling them, all they did is change the name of this thing. They didn't have, from the HR was not providing information, saying that it's confidential. He sent the actuary gave a report, the auditor signed it. The next year when you looked at it, the balances, everything remained the same. Then said, why is this? Because the company is showing more employees, whereas it's not reflected. Then they said, sir, humne last year galti kiya. Now just imagine, you as an auditor looked at the information. What is your responsibility under standards on auditing when you're using the work of an expert? You need to validate his competency. You need to validate the information that is provided to that expert. And you need to say that whatever the information provided is as per the books and records. And that is something which is very important. Restated balance at the beginning of the current reporting period will have an impact, and it's called restated accounts. Another important change which has really come up is the changes because of if there is a change in fair value because of your own credit risk. My debtors have gone, my losses have gone up, my rating have gone down. Because of my own credit risk, anything has gone through. Any changes in fair value of assets or liabilities cannot go into what is called as P&L account. Any changes in the fair value because of own credit risk on financial liabilities designated at fair value through profit and loss account will now be recognized under retained earnings. You cannot flow that credit risk because of your own performance, because of your own changes. If there is, because of which your credit risk from 8.5, it's gone to 9, that credit risk factor which has gone up, that 0.5 will now come considered as your credit own risk, and any changes which ideally identified as fair value through P&L account, which should ideally should go to P&L account, will now be classified under retained earnings. And this is a significant change. And this is in line with the changes that have been brought in the accounting standards. The Ind AS standards, which has got significant changes, have this FV changes relating to the own credit risk. What are the other changes that have been brought in? Now, the other changes that have been brought in is in the quarterly returns. And I think this is something which is very, very critical. In the quarterly returns, if you look at it, any loans that has been taken, right? Any loans that have been taken, again, they have classified any borrowings in excess of 5 crores. Again, borrowings doesn't mean what is utilized. Borrowings means what has been granted to you. That means you have not drawn, right? You have been sanctioned loan, but you have not drawn the loan. Even that would be classified. It is any loans, banks, financial together, you need to look at it, and this becomes applicable. Utilization of borrowed funds and share premium and conduit lending and borrowings, and again, whether it is written or otherwise, if you have given any funds borrowed from the parent or the holding company and diverted to advances to your subsidiaries, joint venture, associates, anyone, you need to give the details of date, amount, details of intermediary and the ultimate beneficiary. And if it is transferred outside of India, you need to give if there is compliance under the FCMA Act, Foreign Exchange Management Act. Look at the amount of responsibility that is casted both at the auditor level as well as at the professional level. It's going to have a significant impact. The other aspect which I talked about is Benami transactions. This is something which you need to provide information on property, amount, details of beneficiaries, property which is referenced in financial balance sheet, property not in the books, details, all of these will require to be given. And willful defaulter also already have touched. This has an impact both in the processes as well as in the teams. Disclosure of charges or satisfaction need to be registered. This information should be captured. Details of company not where the funds have been borrowed but not utilized, you need to bring in. It has an impact on process, it has an impact on technology. Specific tracking mechanism. Please work with your clients. Please work with the people with the treasury team or the finance team to look at specific aspect relating to this as current ratio. This is basically the solvency ratios. Now this solvency ratio, if it's a listed company, now gets covered under the LODR regulations as part of the board's report. So therefore, every board should have all of these ratios, and if this beyond 25%, you need to go and explain. And the company would explain in board's report. You need to give it as part of the disclosures. Now, this brings in a fundamental question. So let's assume, under SA 570R, which is basically the evaluation of a going concern, right? In evaluation of a going concern, you come back and say, hey, listen, the company's financial statements have been prepared on a going concern basis. But if there are ratios which are negative, which has got a variance of beyond 25%, let's say, right? How does your going concern evaluation will be appropriate? Because if your ratios are so negative, fundamentally somebody looks at the financial statements and the auditor's report and say the financial statements have been prepared on a going concern basis, but the ratios are negative, that the current ratios are not appropriate, the debt service ratios are not appropriate, return on equity is not appropriate, inventory turnover is very high. How do you justify as an auditor on evaluation of a going concern as SA 570R? That is a fundamental question that will be raised by anyone, any stakeholder, bankers and all that. So therefore, evaluation of a going concern, please link it to solvency ratios, because you cannot have a situation where you are borrowing, and then say that the financial statements have been prepared on a going concern basis. Not only for the company that you are an auditor and standalone, it is applicable for subsidiaries, it's applicable for all other companies where you're going to, and this will have a significant impact. Schemes of arrangement, again, it's compliance with the accounting standard, any deviation to be provided. I've talked about section 8, clause 87 of subsection 2 relating to 2 layers of companies. You cannot have more than 2 layers of investment companies. And again, this is again for those Benami transactions, which was reported at all having in tax haven countries, where you park your funds either in Isle of Man, or you park in some of the Mauritius Island, or in Singapore, or in any African countries. These are some things where you cannot have more than 2 layers of investment companies. And I think that's a very significant aspect of it, which needs to be reported. Transactions with those companies which are struck off, any amounts that are outstanding in receivables, in investments, in payables, all needs to be verified. Please go through the link of MCA website and look for struck off companies. Those companies' information be captured, and those need to be identified. If there are balances outstanding, straight away, either you question this transaction, you provide the transaction, give a disclosure, look at it from a fraudulent transaction perspective, look at from section 143(12) aspect also. So this was a change where the schedule 3 had talked about, and this had an impact as far as the companies or the professional accountant service. Again, I'm coming back that all the CFOs who have got registered with the CA Institute, who are classified under professional accountant in service, will need to comply to this code of ethics, which requires you to provide information that is required, which is true and correct. It's not true and fair for an auditor. It's a true and a correct statement. And therefore, the onus is on this. Any non-compliance, whether it's an auditor level or at the company level, the CFO also would be held responsible of having similar charges, which a professional is in practice follows through it. So it's the manner in which both of them would be treated will be the same. So no longer you can say auditor ne dekh liya tha sir, humne auditor se believe kiya. The answer is no. Every transaction that is entered is signed off by the CFO. The CFO might say, sir, hum log to sign nahi karte. No, you are responsible because you are the signatory to the financial statement. You are responsible because under section 134(5)(e), where you say the CFO and the CEO are responsible to the board for preparing of financial statements. You are responsible for the IFC, the manner in which it operates. That is the reason why I'm saying CFO in practice will have a challenge when it comes, when this schedule 3 is actually hits the road, when the first financial statements are expected and gets approved by 30th September 2022. Responsibility is both at the CFO level as well. All this while we were only talking about professional practice, professionals in practice who were impacted. Now professional services also would get impacted because of this. What are the guiding principles on CARO 2016? What really happened and why did the change come through it? They said that the auditor does not do enough. The auditor says, based on information and explanation provided to us, nothing has come to our attention based on information. Now it's all this information and explanation has changed to based on examination. Look at the change. Examination requires you to go and verify. Basis of information and explanation requires you to only inquire. Inquiry is a review. Examination is an audit. So look at the difference, and that's where the consistency was missing. Based on recommendations by the registrar, based on recommendation of ROC, based on representation by industry and bankers, based on the changing needs, this CARO 2020 has undergone change. Now, what is the one thing which is very, very difficult? The one thing which is very difficult for all of us is, how do you identify proprietary of a transaction? See, if somebody will say CADG auditor sir, wo proprietary to find out kar sakte hain. But in a private company, how do you identify the proprietary of a transaction? Only the person who does the transaction knows where the money has gone. Only the person who structured the transaction knows where the money has gone. And look at some of these aspects. Large scale diversion. In fact, one of the aspects is we still are struggling with 8 lakh crores of bad loans staring at all the banks. And this predominantly is because of frauds which are happened on the banks. And who does the frauds? The frauds are done by the company on the banks. Large scale diversion of funds and siphoning, lack of scrutiny of scrutiny for whistleblower mechanism. Now, whistleblower is again any companies whose borrowing is more than 50 crores need to have visual mechanism. That means complaints to be given. Who should be getting the complaints? Not the company, not the directors, not the executives, but by the directors who are independent. And this is something which you have to go back and revisit. Lack of diligence in lending transaction, financial ratios adverse, non-compliance with prudential accounting, misuse of provision relating to immovable property. All of these brought in. Material uncertainties regarding prepayment of liabilities, adequacy of internal audit, borrowings, misuse, diversion, investments. Look at all of these. All of these will stare at us tomorrow when we sign off the financial statement on March 31st, 2022. When we imprint, if we do not do enough, whether at the company level or at the reporting level, we cannot go under what is called SA 250 on representation, written representations. We cannot go under that. We have to do the audit, which is very, very important. Effective 1st of April 2021, it's already kicked in. That means your returns, quarterly returns is already, if you want to test, do a test sample of quarterly returns. It's already kicked in. Concept of materiality, period in the whole accounting year, applicability of reporting, everyone is considered. Evidencing. This is where the whole issue is coming. It's now talking about evidencing whatever opinion that we are giving as a part of under the CARO. So what should you do? One of the important aspects, what should you do? Submit a questionnaire. But before you submit a questionnaire, you need to understand what's happening. Specific inquiries in writing on all important matters. Replies in writing from all the companies signed by responsible officer. Discussions with the management. Checklist documents prepared and discussed with. Look at all of these aspects of it. If you have to do all of these, you have to stay invested. You need to know about your company. You need to know about your client. You need to interact with the client early. And these are some things which are very, very essential. Now, if you look at the classification again under a CARO, maintenance proper records, please do not repeat the same question of saying that the CARO, either company is in the process of updation, no longer you're going to have this. I'm telling you this year, luckily the companies have escaped of audit trail for maintenance of record. Next year, as an auditor, when we are effective 1st of April 2021-22, we may have to look at audit trail also. An audit trail is every transaction. You can't maintain in Tally, you can't maintain QuickBooks, you can't maintain Excel sheet, you can't make it match. You need to have a trail where you cannot change, you can't edit. When that being the case, how are you going to manage? Audit no longer is going to be an area where it is a comfort zone. Audit is no longer a time where you can go and spend, whether it is banks, you have a bank audits, or whether it's a CAG audits, whether it's a company audits, whether it's no longer you are the brother-in-law, father-in-law, son-in-laws. Now you have to play the role of more or less like a regulator, more or less like a forensic audit. Because why I'm saying why this is important. Who is going to protect you? No one. No professional will be able, none will protect you. It is you who have to protect yourself. Your signature, somebody might say CA signature is mightier than anyone, than the sword. But the same signature will come as a sword on you if you do not follow the processes that are duly to be followed. Please refrain. Again, I'm saying risk. Professional as an auditor should not have risk appetite. Risk appetite should be reduced. 2, you should have an understanding of a situation, but you should not have a non-compliance to a situation. 3, report on facts. Be fearless. Report on facts. Businesses come, businesses go. But your signatures is mightier than anything else. Report on facts. 4th, call out when it is needed. Call out when it is needed. If you have to resign, you resign. but state the reason. Do not say because of preoccupied you resign. You say because of A, B, C, D, E, I have resigned. State the facts. It protects you. And I think these are some things, a great lesson. Just imagine a recent NEFRA order on an Indian firm is just the beginning. And there are more than 8,000 companies which are audited by the small firms also. And if anything comes through it, the onus is on us to demonstrate that we did the right thing at the time the information is available. So the CARO 2020 talks about evidencing, not based on information and explanation provided, and therefore we say that. Maintenance proper records, physical verification of property management, title deeds. Do not say that the company is in the process of carrying out or the company carries out a physical verification of fixed assets at reasonable intervals. Define reasonable intervals. And when was the last time the company had carried out physical verification of fixed assets? Benami Properties, physical verification of inventory. Very important aspect of it here is about threshold, which has been defined as 10%. Threshold on line by line. It could be raw materials. It could be finished goods. It could be work in progress. Again, within work in progress, thresholds could be different. Any discrepancy beyond 10%, you cannot go back and say the company is in the process of carrying out physical verification, or the company has carried out physical verification, is in the process of reconciling. Arey Baba, if it is not reconciled, how did you give an opinion on the inventories on the balance sheet? How did you give an opinion on the internal control on that? So there is nothing called in the process. If it is discrepancy is more than 10%, straight away, please report. Working capital limits in excess of 5 crores, submission of quarterly returns, investment guarantees, loans and joint ventures, repayments of overdue more than 90 days, which is also there today. If there are any overdues which are there for loans for repayments, the company has not taken reasonable steps, you need to look at it. Where the company is not in the business of giving loans, basically your NBFCs, whether fresh loans were granted to settle the existing loans. Please look at rollovers of transactions, repayable amounts, loans and investments, guarantees, securities, whether provisions of section 185 on loans to directors and loans to companies, acceptance of deposits, maintenance of cost records, depositing of undisputed statutory dues, disclosures of all statutory dues under dispute, whether you made a provision or not made a provision, recording of unrecorded income. This is a very important aspect. Default in repayment of loans and other borrowings, where the company is willful defaulters, term loans applied for the purpose which is issued, funds raised on short-term funds used for long-term purposes, taken monies, companies taken loans and utilized for subsidiary joint venture, company raised loans on pledge of securities, your own subsidiaries, joint ventures, using them for pledging. So far, it was being seen as security given. Now go back to each of these loans. Look at which entities subsidiary have been pledged. You have to bring in all of this information. Application of money raised, including debt instruments, compliance on private placements and preferential allotment, fraud by on the company, Please look at all of these very closely. Whether any report under section 143.12 has been filed, whether auditor has considered whistleblower complaints. Whistleblower complaints is something which is very important. Maintenance of unencumbered term deposit by any of the companies, default in repayment of interest on deposits, compliance on section 171.88 on related party transactions, internal audit commensurate with the size and nature of business, and whether you have reviewed the internal audit. If the internal audit says information not there, and qualified the internal audit report. For instance, you have some internal audit report which says there's a deficiency. As a statutory auditor, you cannot give a clean report. You need to look at all of these. Valid certifications of NBFCs and all of these. All of these clauses, you need to look at 47 clauses. You need to look at cash losses incurred during the financial years, auditor taking into consideration issues, objections by outgoing auditors. Outgoing auditors, please do not say because of preoccupation, state the facts. On the basis of financial ratios, aging and expected dates of realizations, management plans, whether there is an uncertainty, whether the management is in a position to meet the liability at the existing date. Look at the responsibility on you as an auditor. I think that is very, very important. Transfer of unspent money to a fund in case of ongoing CSR, transfer of unspent money to a fund, qualification and adverse remarks by the auditors. especially in consolidated financial statement. This is not applicable for standalone, but for consolidated financial statement. If any of, and you are supposed to get all of this information completely. Internal, you see the red flags are almost 10. 10 red flags is what you need to be very, very cognizant. 47 clauses, numbers which you need to report, even though the clauses are about 21, but you need to report on 41 clauses and including sub-clauses. And all of these will have a significant impact as far as the auditors are concerned. Mind you, these are some of the things which are overlapping on the Companies Act also, on the Schedule 3. But look at this. Earlier, CARO 2020 came without a changes in Schedule 3. Now today, Schedule 3 has undergone change, which means the company will be reporting, the auditors will be reporting, but the auditor has to do more. Who are the people should be involved? The people who are at the senior level should be involved in all of this, and this becomes a very critical aspect of it. I'll pause here, and if there are any questions relating to do this, I will take it up.
Ganeshji, some questions have been asked by the participants. Satyanarayan Murthy sir, he is asking, like he's stating like this: directors contend that the capital expenditure is made out of cash accruals during the year in the case of profit-making companies with accumulated surplus, and this cannot be disputed. How to accept that no diversion has taken place?
There are two aspects of it one should look at it, and this is a very very important question which is to be answered by all of us. One argument which will come back to you is saying that if you prepare a cash flow statement, cash generated from operating activities, right, is greater than cash used in investing activities, right? So in other words, your operating activity is generated internal accruals. That's basically, that's your test, right? That is one approach. It's called the indirect approach. The other approach is, okay, sir, you said you got the profit. Where is the profit lying? Profit is lying in your debtors. Monies have not received. What have you done with that money? You have not received the money. Debtors are showing up in a different level, but you have borrowed funds and utilized that funds. So one way, you see, the more the debtors, that means it's equivalent to as if you have used the money. That's how we learn, right? So when you look at higher the debtors, that means even though you have got a book profit, but the actual profit is not translated in your operating activity. And that is something which you need to look at. So if you have to go, either you get an utilization certificate, that means receipts, payments, that is one way to do it. Alternatively, indirectly, look at your operating activity, look at the cash flows from such operating activity, compare but the amounts you used in investing activity. If the amount accrued from the operating activity is greater than the investing activity, it means they've generated internal. Else, they've utilized it from borrowed funds. And this is something which you need to be very careful. Next.
Well said, sir. I think that clarifies the question, that gives clarity on the topic. The next question is Kondal Reddy. He is asking how to ensure classification under trade receivables, especially C, trade receivables that have an increase in credit risk that is significant, and D, trade receivables credit impaired.
So let me go back by the classification, right? You need to first of all understand which business your client is in, right? Is he in a business of real estate infrastructure? Is he in a business of building materials? Is he in a business of life sciences? Is he in a business of trading? Is he in a business of jewelry? Is he in a business of restaurant? Is he in a business? Which business is he? Every business has its own risk. So what do? So you say that every company enters into a transaction with a document saying that 90 days credit period. If all the amounts are received within 90 days, then you don't have to be bothered about it. But if this 90 days becomes 270 days, Has the credit risk gone up? The answer is yes. The 270 days has become 365, 730, 1050. Is it impaired? The answer is yes. Leave all this. What you have sold, the person left the company, or let the company, the person has disappeared, or you have sold to that person and there's no transaction with that person. This is where you evaluate. Why did you suspend the transactions? Why did you not continue the transactions? Why is the amount of, you can't say, sir, I will get you a confirmation. Confirmation of a balance is to establish under the Negotiable Instruments Act, saying that in the event of when I take a legal dispute, period of limitation does not apply. That does not mean that these receivables are good and recoverable. These are not good and recoverable. The good and recoverable are those which are demonstrated only through receipts. And that is where you need to evaluate. That's the reason I said, go back to the table and you will know, every auditors know, every year and a year you will get to know, sir, ye mil jayega, sir, ido chesan, sir, next year, he will give. If you go to 31st of March, sir, 30th of June. If you go to 30th of June, sir, 30th of September. You go to 30th of September, 31st of December. Goal post changes by 3 months. As much as in an internal audit, you've got an action taken report, have an action taken realization report. Probably your credit risk and credit impairment can be addressed. Next
Yes.
question.
Venkat Suresh Kumar has raised a query. He's asking, is it mandatory to give all the amended Schedule 3 disclosures, or is it based on applicability? Like, if there are no transactions with struck-off companies, do we still have to disclose stating that there are no transactions with struck-off companies?
You have to state so. You have to state facts. You have this mandatory, and you have to show it facts. These are facts which you should disclose.
So that's straight. The Ramakrishna V wants to know, for amounts contributed as CSR to various agencies, whether the utilization by them has to be completed within the financial year, or can it be in the next year?
So this is a very important question, because there are two ways you look at it. If you have said for what purposes you have given the money, right? You will not contribute. So somebody says, I want to buy a vehicle, right? So if you have to buy a vehicle, do you wait for next year to come, or you give it just like that? Somebody says, sir, I've got a meals, to take care of the, all this, the people who are very poor, being downtrodden and all that I have to give. So whenever you give it to others, it has to be spent during that period. We can't expect 1 year, after 1 year, we will do it. Unless you're building an oxygen plant, which takes about 6 months, 9 months, and therefore you see the progress, how it is being done. Probably that is where you can address all of these.
Yes.
Next.
An anonymous attendee wants to know whether trade receivables disclosure in the notes will get changed based on the aging table, or can we continue with the earlier disclosure that is considered good and doubtful?
No.
Please clarify.
This is effective 1st of April. All changes will happen effective that day. Effective that it means all balance sheet changes based on Division 1, Division 2, Division 3 is applicable. You have to bring the current change. You can't go back to the old one. If you do it, it becomes non-compliance.
Another question from Chaitanya. Any missing pieces, say aging of payables not made available, does it translate to a qualified opinion?
Answer is yes. Answer is yes. How material it is? If it is very material, you have to do it. You have to do it. If it's very, very material, you have to do it.
So Chaitanya, that's it. You got a very clear-cut answer. And Ram Krishna again asks whether aging analysis of receivables and payables for the previous year also to be given.
This is a fundamental point, because when you're doing a ratio analysis, right? When you're doing a ratio analysis, you have to give a compare between current period and previous period, right? And that is something which is very, very critical. That is very, very critical, because if you don't give that information, if you don't prepare that information, how will you prepare a ratio? And the ratio will not be there if you do not do that comparison. So therefore, while today the Schedule 3 is silent, my recommendation is please have this information collated. Next.
Utilization of borrowings note is applicable if the working capital loan proceeds were utilized by giving as loans to unincorporated joint ventures.
I'm not seeing the question. I mean, I'm not understood the question. What is the question?
Utilization
of boards is applicable if the working capital loan proceeds were utilized by giving as loans as to unincorporated. So I'm not able to understand question. So let's look at this way. Any utilization of borrowings, right? Any utilization of borrowings, if let's say whether it's a working capital loan, any loans, working capital loan, security loan, anything you have taken, if you have given to anyone, unincorporated, corporated, relative, partner, promoter, key manager, anyone, you need to provide that information of how that money has been utilized by those ventures. You have to provide that.
Yes, sir. I think it will be a diversion only because
Diversion only, yes.
cannot be given for a joint venture unless they have raised a special loan for joint venture. And definitely, I think it will be a diversion. Well, it depends on the situation. He's also asking, another anonymous attendee wants to know, how can we classify the receivables in new aging buckets if my provision for doubtful debts is based on ECL method? Meaning the ECL is applicable as percentage on all receivables, including considered good.
So this is a very beautiful story. All this while we were hiding under ECL method, right? It was never classified between what are disputed and undisputed, between an impaired, between a legal and a non-legal, between considered good, not considered good, right? ECL method so far was using that basis, and in fact many companies for legal, they've actually taken a decision to provide for it unless the legal case is in favor of them, right? Otherwise your ECL method will not work under this classification between undisputed and disputed, between impaired and where the credit risk have gone. So now you have to revisit that aspect, and this is where I'm said now we have to do more. The company has to do more first, and then the ECL method is under the accounting standard aspect, whereas this is an aspect under the Companies Act, where the company will say, listen, these are disputed, impaired, credit risk, they will classify it. You as an auditor, under that, you will go back and do it, whether there is a policy relating to write-off disputed dues, whether what is the policy relating to credit risk, what is the bucket. Still, you may use the same bucketing, but the classification will have an impact, and it will not remain the same because year after year, people will question that aspect.
Sir, Premnath ji is asking two questions. What he is asking is, what does turnover mean in trade payables turnover ratio as per revised schedule 3? And also inventory turnover ratio. What is the meaning of turnover? Your views, please.
So you go by the turnover ratios on purchases versus opening plus closing. You still go by the same basis. The method is the same. Data, whether it's a sales or purchases, the ratios remains the same. There is no change. Revenue, the turnover, the moment you say revenue, there is a difference between a total income and a revenue. A revenue which includes both direct revenue and operating income revenue. So therefore, you need to look revenue. That's how the classification are based on companies. And therefore, whatever is the ratios that we're using, whether it's a capital budgeting, whether it's a project financing, or for the matter, even for our own income tax purposes, right? Under tax audit report, we give ratios, right? The ratios so far, they have not redefined. They have not said whether it's average, whether it is opening plus closing, whether it's credit sales versus by this, whether it is total sales versus this. That's exactly where the clarity is still not there. But you can define saying that this is a total revenue, means revenue is credit sales, cash sales anyway don't have that ratio, right? You automatically have cash. So therefore, from that perspective, where you calculate the ratios.
Sir, Chaitanya is asking again, do you foresee a vicarious liability on auditors from banks?
Yes.
For application of funds as per,
Absolutely, yes. This is where I'm saying, please have the forensic mind. Please use tools. Please do not just accept what the companies does.
I think the banks are lodging complaints before this reason.
You know, in fact, in the discussion that I had with Mr. Chopra was the same thing. He says, Maximum cases have come back from the banks and from the tax agencies.
I don't know whether this is for related, sir, but anyway, I'll ask this question from Srinivas, whether non-executive directors draw remuneration from the company.
So it's a peculiar situation, right? So typically a non-executive director generally don't draw us remuneration, but they may get some sort of commission. But you know, it all depends upon, you need to go and look at the relationship between this non-executive director.
Yeah, yes, sir. Chandrasekhar wants to know, the financial year ended on 31st March 21. Balance sheet is signed on 25th August 21. Whether company has to give effect to the amendments in the financial statements.
No, you don't need to give any, this is effective 1st of April, and therefore this is applicable for 31st March 2022.
That is the reporting period ended 31st March.
March 2022, yeah.
Satyanarayan Murthy sir is having a follow-up question. Is there any guidance on disputed and undisputed, secured and unsecured aspect of loans and advances and receivables?
Sir, it's like saying that, you know, in a family, you are saying whether there's a dispute. So how do you define a guidance for a dispute? Dispute is basically nothing but the transaction that you happened with the company and the money is not disputed either for the quality of the product, as is disputed for the terms of conditions, as is disputed for the delivery, either he is disputed for any of this. So those are the things which becomes very important. So disputed means when there is a disagreement between the buyer and the seller in a commercial transactions, whether it could be price, quality, delivery, could be anything else. And a dispute is where you need to go and examine the documents. That means when a payment is not received, you can have to go and examine the documents, and all of those documents have to be re-looked at it, both from a legal perspective as well as from a, I would say, from a classification perspective.
Sir. What are the sources or documents from which litigations or proceedings initiated against the company with respect to Benami transactions can be identified by the auditor?
Okay, the first and the foremost thing for an auditor, look at how much of the legal expenses, how much of professionals they've used, how much of consultants they've used for any of the matters. Get to know all of that. That's number one. Number two, there are various sources that you can get, right? You can get from ROC, you can get from TDS website, you can get from High Court. There are various sources from where you can source all of this information. With technology being there, this is something which you can exploit and get that.
Yes, sir. I think we need to do some homework, and we need to use some external sources also, resources also.
Yes.
Kundal Reddy wants to know, do we need to disclose unrelated supplier or customer?
Yes, which is from the stock of company, right? If there are any stock of from the stock of companies, you have got transactions, you need to disclose it.
Yeah. Yes, sir. Date of applicability of new CARO and Schedule 3, I think you have already answered.
21, yeah.
Already answered. Then Ravinder Nagireddy wants to know, how could we ensure the utilization of working capital term loans are meeting the requirements? Director can simply say it is for furtherance of business only. There is a slight control we need to understand.
Okay, so let me put it this way, right? Now the reporting is very clear. You cannot be taking any money, right? You can't borrow any money. Suppose if I borrowed money for my working capital, I cannot be utilizing this money other than from my supplies, other from payment, other from my operating expense, to buying a fixed assets or giving an advance to somebody else, right? How do we do it? Simple. If you say I'm a very layman, right? First time I'm just attending accounts, I'll say bank statement, get the receipts, get the payments. Simple. Get for all of this. Scrutinize each of these transactions. Identify those transactions. From there, you will be able to identify whether it is for the purposes. So working capital, if you had any name of a capital vendor, if you have any name of any of the companies, that means simple as diversions.
So this takes us back to the very old debatable issue of paying of EMIs for
exactly
vehicles and
exactly. for the purpose for which it is done.
Yes, sir. So what do you say, sir? It's a diversion if I
It's a
pay.
diversion. It will be a diversion. That's now again I'm telling you, diversions are, this is where the reporting responsibility has gone up on the. I'm saying people have to understand the severity which is impacting the professionals. And if we don't do it, we run into a problem.
Naisharam Chandrasekhar is raising a question on leasehold property and non-cancelable leases. If the property is under severe distress and right to use the property is severely impaired, how to deal with the situation? Of course, the company is paying rents as usual.
Correct. So the question then is, if it is in distress, it is impact on the adverse solvency ratios. If the solvency ratios are impacted, going concern is impacted. And under those situations, as an auditor, as a company, there are two ways. What are the alternate ways where the company is trying to get this information to manage the finances? If the company has got alternative bases and which it would be a budget for a year or short-term, medium-term budgets, you've looked at all of this. And if they're on the basis on which the company is going to run, probably you can appropriately address it. Otherwise, in fact, if you take the example of the malls, right? Many of the malls, you take cinema halls, all have gone. They're not able to manage. They are in complete distress, right? Now, the question then is that if you don't have alternative business, you may have to raise the issue on going concern itself. Next, if a solvency ratio is more less than 25%, no, ratios you have to give, but explanations of variations is only about 25% you need to give. So ratios you still compute and give it.
Yes, sir. Stock statement filed before quarterly closing of books, that is by 10th of subsequent month. How to ensure it is matching with books?
No, so therefore what you should do, tell your client that the client should keep this information ready beforehand and you should validate it. Now itself you educate the client saying that please, whatever you're submitting, all of this information should be as of 30th of June, 31st of March, 30th of September, 31st of December.
So there are some questions relating to applicability for which financial year. I think that you already answered. Financial year 21-22 is the answer. So we will not take those questions, sir. So now going to the next question. Some old NBFCs have not filed satisfaction of charge with the ROC and are not available with those NBFCs. There are no outstanding in the books.
Then
Is
it's not required
to be reported.
Then it's not required. If you don't have any money, no charge, nothing is there, then it's not required. The charge is basically to demonstrate that there is a borrowed fund. You're classifying it as a secured loan. Secured means that you've secured against your property or purchased against property. That property is under hypothecation with somebody else, and that's what charge is all about.
Sir, Vijay Kumar wants to know, a company A borrows and invests in B company as share capital. Majority of the directors are common. Where to report? Is it okay if we report in CARO?
And this is a serious issue. This is a diversion of funds. You can't borrow funds and invest in a share capital. Even today, director says you cannot invest in a share capital from a borrowed fund, even today. And this is a clear case of a diversion which you need to do it.
Another question from Ravinder. Is there any clear tabular disclosure required in financials or reconciliation of quarterly statements submitted to bank versus the actual figures?
No, our reporting, if your annual, we are only going to issue annual reports, right? So in your annual report, you can tabulate June, September, December, and March. So that you can do the classification. As per books, you can also make a general statement saying that we have examined the books and the information that is provided to this is as per this. But when you get a management representation letter, in that include what is the numbers that you've included when you're reporting it. You are taking the responsibility in saying it is as per books. So therefore, very well, you have all this information supporting documents with you as part of your work documentation, which is under SA 230.
Yes, sir. Anonymous attendees, the receivable which will be shown in aging buckets is net of provision for doubtful debts.
It's gross, and then where you're impaired, that goes as net.
So clear, sir? Okay. Next, what is the frequency in which immovable properties are to be valued, whether as an owner or as an investment?
No, if you are, it's a fair value through P&L account, then you do it. But generally, investment property, immovable properties are not. So it is based upon the choice of accounting standard that you use, whether you're doing on a fair value. And if the changes are significant, then you do regularly. Otherwise, you do whenever it is needed in a time period.
So one case-specific question by Bhaskar Chitti.
Hmm.
Directors' remuneration in a private limited company is fluctuating every year. Some years it is high and some years it is low. Total amount withdrawn as advance from company is being treated as remuneration. Is there any problem and
Yeah.
how to report this?
It will be a problem. It will be a problem. You need to comply with the Managerial Remuneration Act section. And under managerial remuneration, if it is within that, then probably they can do it. But you cannot give an advance to a director unless if it is permitted for all of them and in the, as a contractual term. You cannot have just give an advance and do it. And this is something which is a problem for many of the private companies where the directors draws as advance and say you adjust against my remuneration. And sometimes when they are inadequacy of profits, it has run into a non-compliance.
And also you have the problem of deemed dividend under the
Correct. Under the Income Tax Act, yeah.
In the case of good old companies, the directors would not be in possession of title deeds. How to report? Well,
In fact, this is exactly the problem is. So if you're saying that the company is the owner of the property, then it should be in the name of the company. If directors need not hold that property. But if the company, you show that the directors hold it, but they have not transferred to the company, then that's a problem. And that's where you need to report.
I think he's also stating a factual situation where the documents are not available, they are lost.
And then if it's
I
lost,
think it's
FIR is
certified copies.
yeah, whether you've got no, if FIR, if you filed an FIR, because if you've lost the document, you can't transact in a with the register.
Particular way, like it is impaired.
Yeah.
The title will be restricted.
Yeah.
Well, I don't know what Anwar Iqbal wants to know, but he's just saying reporting on related party transactions. So I think we may not.
So reporting on related party transactions, please identify a relationship not only under the Section Companies Act, but also under the Ind AS and AS 24, AS 18 and Ind AS 24, where it says it includes all of these. So therefore, directly or indirectly is where you get impacted. So related party transaction is requires significant impact.
How can we check the receivables for which credit risk increased from the existing receivables practically?
So when you say a credit, I gave an example. Your credit period is 90 days. Credit period went from 90 days went to 270. Is the credit risk increased? Credit risk means you actually the ability of the company to pay you the money is increased, right? That credit risk 270 became 365 and 730. That means risk of recoverability from that party goes away as the period extends. That's how credit risk is. Credit risk is less if you have cash. Is there a credit risk? The answer is no. If you receive within the credit period, is there a credit risk? The answer is no. But if it is beyond that period, the risk increases.
Well, sir, a supplementary question on the applicability. Would the revised Schedule 3 apply for companies with December 21 year end?
No, no. This is effective 1st of April, fiscal year 1st of April 2021. So therefore, it will be applicable 1st of January 2020.
So 21 is
yeah.
Okay. Then all transactions are routed through all transactions of capital and revenue nature are routed through the same cash credit account. How would you call it diversion?
So this is the onus is on the company. As simple as the onus is on the company. I gave an example where if you can demonstrate your operating cash flows from operating activities greater than cash used in investing activity or financing activity, then you can say that the cash has been utilized, not been diverted. But the onus is on the company to demonstrate that the internal accruals are sitting this and this is the amount. So it is not on anybody else. So the company has to demonstrate. I agree with you that you cannot say, but it is important because suppose you prepare a cash flow and you find your investing and financing activity. Your investing is so take an example. Operating activity cash flow was 100. Investing was 400, right? Where did you get the balance 300? From financing. Now you tell me, if I say internal accruals, it should come from my profit, no? From my operating. That is where you need to be very, very clear on it.
So
You
we
can
need
have,
you do the homework, we have
yes,
to do the analysis and then come to a conclusion.
yes.
So is it compulsory to obtain utilization certificates, end use certificates for donations made under CSR?
Yes, I would ideally would say please obtain this, because tomorrow because one of the in the FAQs that have been released by the Ministry of Corporate Affairs, they've asked for the end use certificate.
Yes, sir, that's very good, and it's always safe for us. What all details will be needed to be checked in the quarterly return submitted to banks? Would utilization of funds for another purpose than sanction need to be reported in this clause also?
Is there a question you're reading, or is it I'm missing something?
What all details will need to be checked with the quarterly return?
So quarterly returns, you will have, you will submit inventory, you will submit receivables, you will submit payables, you will submit guarantees, and all of that. So those are the information what you submit for working capital purposes is what you will validate.
And he says, would utilization of funds for another purpose than sanction need also?
Not in this clause, it's a separate clause. It's a separate clause. One is a question that is raised for quarterly returns. The other is funds used for purpose for which it's drawn is being utilized for other purposes.
Director in holding company brought loan and invested as share capital in subsidiary company. Where to disclose?
Again, I said this is a diversion of fund. You can't take loan and then invest in share capital. There'll be an issue. You need to report on that diversion.
Anwar Iqbal is asking maintenance of inventory on day-to-day basis. Take for example, pharmaceutical distributors deal in hundreds of items, and the company suggests to write a note that the company deals in number of items, and it is not possible for the company to maintain the inventory on day-to-day basis, and the inventory is taken only on the last day of the financial year and it is valued at cost.
So how does I assume this pharmaceutical distributors also deal 100 items. They don't have any borrowings. They do it from their funds, own funds. If that is the case, there's no problem. It is a very, it's another way of saying that, I will not give you information. I think if they have borrowed funds, you need to very well do it. This is a case of borrowed funds. So if they don't have borrowed funds more than 5 crores, you don't even have to look at it. But if they have more than 5 crores is where you need to have this records maintained. I can give you n number of cases. I can tell you one company which deals with 1 lakh items. Do they have an inventory? The answer is yes. They have classification A, B, and C.
Yes, sir. For computation of assets, whether we need to scrutinize the valuation report of the register.
Yes, so for valuation report of register is a different thing, but you need to look at a specific aspect from a valuation certificate, which is given, and based on the register, you need to validate the land title deeds and all of that. That is where you need to look at it.
Yeah, I think we'll have only 2 more questions, sir. We are not taking further questions. Raghunath is asking, in respect of loans advances given, where the amount overdue for more than 90 days, as an auditor, what documents, information need to review to substantiate that reasonable steps have been taken by the company for recovery of the principal and interest?
Sir, it is like this. Principle is, how do you recover a money, right? You call up, you follow up, you send confirmation, you say, if you don't do this, we will initiate actions. You have a process that goes through, right? You keep writing, persuading. It's like you, sir, when you want to get your audit fees, what do? First write a polite mail, second polite mail, third polite mail, fourth you try saying, fifth you say, I'll stop issuing certificate, sixth so the same way, how do you recover your own money? So same way the company also does. The only difference which is between them and this, at least here you know what has happened. There, the company will not tell you what is happening. The best way to do such cases, go and download from ROC if they are a listed company. If they are registered companies, go and download it from any of the information if they are doing any transaction with on GST and all of this, or PAN and all of that. You will be able to get this information and see what the money they're giving. You yourself will be able to identify whether they are in a position to give or not. And that's why I'm saying you have to look beyond what is called as doing an audit. You have to do, it's not barking, it's not watchdog, it is not any bloodhound. It is beyond. Do forensic. I'm saying have the forensic mindset. I'm not saying go and always suspect. have the forensic mindset and do an audit. Things will be better.
Friends, this is the last question I'm asking. We are not taking any further questions. Holding, it's an interesting one. Holding company is not a going concern, but subsidiary is doing good. How do we have any reporting requirements?
So at the subsidiary level, it's not a problem, but at the holding company, it's a problem. The dog wagging the tail or the tail wagging the dog.
Yeah. So thank you, Ganeshji. We had an excellent question answer session. It was really a 2020 sort of a thing. Pat came your answers, no stoppage for thinking or anything. Pat came the replies. Hats off to you. Hats off to your knowledge. Hand you back to the Secretary of Hyderabad branch, Satish. Thank you, Satish, for giving me this opportunity.
Thank you, Bhanu sir, for so patiently taking almost 50 questions. Really grateful to both of you. I request Chairman of Hyderabad Branch CA Macharam Mirvalli to give closing remarks of the session.
Ganesh sir, we are very much grateful for your time and efforts, first of all, and the excellent presentation. You covered almost all critical areas of Schedule 3 and CARO. We have organized a lot of study circle meetings, and our senior friends, our young friends also having a lot of doubts. I think today's your session has clarified most of these doubts. And once again, thanks for accepting our request and joining here for sharing your expertise and experience. And most importantly, sir, your contribution for an ICA and professional at large is a marvelous and fantabulous, and we are really thankful for that. And not only taking the sessions at Hyderabad, you are taking it pan-India, and very importantly, you are supporting the members, young members and students. So for which really thankful, and not only from the Hyderabad members, from ICA, we are really thankful for your contribution and service. Abbas Ali sir, thanks for joining here, and really we are honored to have you here today. And I think last 3 years as a secretary and OH chairman and chairman, and I'm having you 2 times and really blessed. And Ganesh sir having very good regards about you. And thank you, Ganesh sir, for giving a wonderful personality to request him to join as a panelist today. Satish, I request you to present a virtual certificate of appreciation for a contribution.
Thank you, Chairman.
Can we have Abbas on at least for a few minutes?
Sure.
Please, sir.
Abbas sir, I request you to say a few words.
Yeah.
Abbas sir, please. Yeah, I think Abbas sir. Satish, am I audible?
Yeah.
Audible, sir.
Sorry, Ganesh sir, I could not able to join at the beginning because I wasn't traveling.
Hey, that's okay. Absolutely fine.
Yeah, Bhanu sir, I told
go ahead.
4 days back only, Ganesh sir, regarding this CARO and Schedule 3, as we are having a very burning topic and we are regularly discussing about this topic in our study circle meeting. Immediately accepted and supported. Thank you, Ganesh sir, for your great response and taking the class at Hyderabad.
Thank you very much. And
Ganesh sir, please accept our virtual certificate of appreciation as a token of appreciation and gratitude from Hyderabad branch. Thank you, sir.
thank you very much.
Yeah.
Satish sir, is your responsibility to send the physical certificate to Ganesh sir, as Bhanu sir and myself could not able to send by this midnight.
Definitely, sir, definitely. With your permission, I'm winding up the session, sir. As a token, it's my proud privilege to offer vote of thanks on behalf of Hyderabad branch. Ganesh sir, so energetic and so powerful presentation. We're really glad and appreciate that, definitely.
Thank you.
You took so patiently almost 50 plus questions, and your session is so keen and so important. All the members, almost 385 plus members all throughout the session. Thank you very much, sir. Thank you to the chairman and Bhanu sir for taking up the questions. Thank you, my management committee colleagues, vice chairman Deepak Ladda, Sitaram Reddy Garu, and other members. Thank you, everyone. With this, we are winding up the session. We'll see you very shortly.
Thank you.
Sir.
Thank you.
Thank you. Thank you.
Ganesh sir, thank you,
Thank you,
sir.
Ganesh sir.
Thank you so much.
Thank you all the delegates for joining.
Thank you, Bhanu sir.
Thank you, Satish.
Chairman, thank you, sir.
Thank you, Chairman. Thank you, ACS.
Thank you, sir.